microphone this evening, but I was told I'm going to have to use it one way or the other, so I'd like to thank you for joining us this evening. On behalf of Ketel Thorstenson, I'd like to welcome you to this presentation of the Tax Cuts and Jobs seminar that we're presenting this evening. For those of you who don't know me, I'm sure there are a few. My name is Rex Vigorin. I'm a partner here in the Spearfish office, CPA, and we have some very quick administrative details that we'd like to share with you at that point. If you wouldn't mind putting your cell phone on silence as we go through the seminar for the evening. In addition to that, of course, we have restrooms over to your right in the hallway right here, so that would be take care of that. And I think hopefully all of you have had an opportunity to have some water or coffee on the tables in the rear. We will be taking questions this evening. However, those should be held, if you wouldn't mind, until the end of the presentation at that point. So we'll go ahead and do that. Lately, we have been immersed in the Tax Cuts and Jobs Act since December 22nd. And of course, that was the date the President signed it. It has over 1,000 pages in it, and needless to say, it has plenty of details. Hopefully this evening we'll be able to explain many of those and give you an opportunity to ask some questions on that. Even though the law is only 25 days old, I think that there's probably something in it for absolutely everybody, whether you like it or not. We'll be presenting highlights on it as we go through the seminar this evening, and some various tax strategies on which you might be able to consider as far as using it for 2018. For those of you who are not familiar with our firm, Ketel Thorstenson has locations in Spearfish, Custer, Rapid City, and Spearfish. We have 16 partners and approximately 115 staff. As a full accounting service firm at this point, of course, we do the usual. The tax preparation, tax planning, auditing for outside third parties, as well as accounting services. As far as I don't believe we've got, don't have it up there, but you'll do that. Thank you. Just a little bit behind here as we go. The services that we have available to you at this point are listed on the screen as far as those go, so that I'm sure that you can read, and I don't need to list those as they go through. But needless to say, they're all listed there. In addition, those are the departments that we have in our firm, in addition to certainly highlighting some of our evaluation work that we do internally. The most valuable service probably that you're looking at is those that pertain to tax preparation, tax planning. We deal with certainly Affordable Care Act compliance accounting on that. In addition to, of course, W-2s and 1099s that are due at the end of this month if you're not in tune with the dating. Affordable Care, as we were just talking about, and QuickBooks assistance. We service many of the industries that you see there, and again are outlined both in your handbook as well as on the screen. We really like to provide great service. We try very, very hard to do that, as well as providing education, and are always available to answer questions that you may have and to address any of the particular tax issues or other problems that you may be encountering. We have a great passion for what we do, and I think you will see it demonstrated this evening in the presentation that we have, and I'm sure that you will enjoy it as we go through. Our speakers this evening are 4 in number. I have 3 of my partners along with us this evening, along with our senior tax manager from Spearfish. We have Kevin Sickels, Jennifer Konvalin, Michelle Minnerath, and Jess Weaver. And with that, let the fun begin. And Kevin, you want to start us out?
Okay, well. So, as Rex mentioned, the Tax Cut and Jobs Act of 2017 was issued and signed by the President on December 22nd. In general, I can say that the bill has impact on every individual tax return, probably every business tax return, and almost everybody's tax will be low. So That's a pretty blanket statement, but I think it's a good thing and should make everybody excited. So you'll find, as we're going through this, that most of the provisions in the act are not effective for 2017. So the tax return you're filing right now, for last year, will be on the old rules. There's only 3 things that changed, and you'll see those as we go through the presentation. You'll also see that there's, on the slides, we've tried to indicate which provisions in the bill sunset, which means they just go away at some point, and which ones are permanent in the law that can't change until Congress changes them. Because there's nothing permanent with the way Congress is set up. So, but the ones that sunset automatically sunset at the end of 2025. And then, so in 2026, by default, if nothing else would be legislated, we'd go back to the rules that were there for 2017. So the first set of provisions that I'm going to talk about are depreciation related. Now, if you're in business, this is one of the bigger topics, because basically what these provisions allow is you to deduct everything you want to. You go buy it, you can expense it if you want to. On the personal property side. There's even some real property improvements that will let you expense those as well. So the first one is section 179, which has been in the law for 30 to 50 years, somewhere in there. Last year, for 2017, it was about $500,000. The provision moved that up to $1 million. And that doesn't start phasing out until you buy more than $2.5 million of assets. So this is truly a small business provision. It allows you to expense the personal property that you buy. But a company like GE can't use this because they buy probably $2.5 million every week. So, so that's a good increase, and it allows you to take that deduction in the first year. Then these other 3 pieces on the slide are the qualified real property. So this one is very good if you have commercial buildings, so non-residential rental buildings. If you make improvements to your roof, heating, cooling, fire alarm, fire protection, alarm systems, security systems, all of those are now eligible for 179. So you're taking something that was probably a 39-year asset and accelerating and deducting it in the year you do it. So this kind of, the repair regs that have been in place for several years now, that tell you when you can expense something as a repair or when you have to capitalize it, now are less onerous, because now even if you capitalize it, you're expensing it under this provision. Or if you call it a repair and the IRS challenges you on it later, well then you can take 179 on it. So you get to the same place. It also allows section 179 on rental property assets. So that would be, you have a rental house, that's your stove, your refrigerator. In the past, 179 was not allowed on rental properties. This now makes them eligible. And then the last one is the SUV provision used to cap, or still does, cap section 179 at 25,000. So you buy a Yukon, 25,000 is your max deduction in the first year. But now that'll adjust for inflation, but it's in 2019, so in 2019 you might be able to take 25,200. So it's inflation adjustment. So not a very big provision, but at least it'll start going up. So then the counter to 179 is bonus depreciation. Bonus depreciation has been in the law since 2000, on and off. We've seen 30%, 50%, 100%, 50%, 0%. It's kind of bounced over that 17 years. So what this does now, the law after September 28th, 2017, you now get 100% bonus. Before September 28th, you get 50% bonus. And the rules are different. For the first part of the year, that 50% bonus is only on new assets. So that's assets that they are the first time they've been used by any taxpayer, period. After September 28th, now the rule is new or used. So you can take it on just about everything. So what that will allow is for you to essentially, like I said, expense everything that you buy that has a shorter than 20-year class life. And this one, you can let it drive your income into a loss if you want. So there's a lot of flexibility with what you can do here with depreciation. The section 139, you have to have income to be able to take it, where this one you don't. And for that period in between September 28th and the end of the year, there's a lot of flexibility because you can take the 100% depreciation, you can take 50% depreciation, you can take normal depreciation, you can take section 139. So a lot of different ways to deduct the same piece of equipment. Autos, for anybody that's ever bought a car that's for business use, you'll know that you don't get much depreciation. It caps out at $3,600 in that first year. Now they've moved that cap to $10,000, and you can see the future years of that car, what you'll be able to get. And for 2018, we still have the bonus depreciation adjustment of $8,000. And now that bonus is eligible for new and used, that means you now get 18 in that first year on a car. So, you know, if you're buying a used car, 18,000 pretty much deducts a fair amount of it. For agricultural equipment, there's 2 new rules, but they're somewhat narrow. So assets that are new, so they put that same new definition that used to be in bonus. They didn't want to get rid of that one apparently, so they moved it over here. So if you have new farm assets, there you now have a 5-year class life versus a 7-year class life. The one advantage that this will give is bonus depreciation you elect out by class. So I can take it on 5-year assets and elect out on 7-year, or vice versa. So what this does for the agricultural taxpayers allows them then to have that flexibility, take bonus on their new equipment, not their used, or vice versa. And then also any 10-year and lower class life will be depreciated over 200% makers, where it's been at 150 for a long time, since '86. This last one, basically what the provision did is it just removed the definition for qualified leasehold improvements, restaurant improvements, and retail improvements. Those 3 definitions have been in the law for several years, and they were kind of confusing because they were all treated a little bit different. So this one just pulled them all out and then just made the qualified improvement property more clear that it is an interior improvement to a non-residential rental building after the property is first placed in service, doesn't include elevators and escalators, doesn't include making the building bigger. So those are eligible for 15-year class life, and since we have 100% bonus, they're eligible for bonus. So again, if you have a non-residential building, you can deduct your improvements to that building. So again, it removes that worry about the repair regulations. So that is all the depreciation changes. Like I said, it's very clear that we will be able to accelerate the depreciation and expensing of items. This next one's a really exciting provision if you were in, if you had more than 10 million of gross receipts and you had to use accrual basis of accounting. This now pulls, there used to be 3 different thresholds depending on your type of business and whether or not you had inventory. So those were 1 million of gross receipts, 5 million, or 10 million. This one, again, kind of scraps all of those and brings in a $25 million threshold. So as long as you're under $25 million of average gross receipts over 3 years, no matter what your business type is, how you're set up, you can use the cash basis of accounting. Also, this moves the contractor rules to that same 25 million. It used to be above 10 million, you had to use percentage of completion. Now you can use cash up to 25. And if you were subject to UNICAP, which is 263A on that bottom bullet, that now is 25 million as well. That's where you have to capitalize some of your overhead into your inventory. If you have inventory and you were over the 10 million, now it's 25. So we'll see a little example on this next slide that you'll see the benefit of what this can do. So in this case, this business has $1 million of receivables and $500,000 of payables. So that means if it made accrual to cash adjustment on its 2018 tax return, it would be allowed a $500,000 deduction. So you get that huge first year benefit, and at, say, it's an S corp and it passes down to the shareholder in the top bracket 37%, I mean, that's 160, 170 grand of cash in the taxpayer's pocket, just by making this election. To do that, you have to file an accounting method change with your tax return, but it's automatic, so you don't have to, you file it with your tax return. So you actually, for 2018, will have until September of 2019 to make the decision, if you extend your tax return to 2018. This one's looks like it's a negative, but it really will have little impact on most taxpayers. So what they did was they took out the personal property language from like-kind exchanges. So now going forward, the only place where you can do a true like-kind exchange for tax and defer your gain is on real property. So for personal property, now what will happen is you'll still probably at the car dealership, the implement dealership, you'll probably still go trade that vehicle, because there's probably reasons to do that. One that I can think of off the top of my head is sales tax. You save sales tax by doing that trade. But then when you do your tax return, you'll actually report the gain on the old car based on the trade-in value, and then capitalize the full new price of the new car or Konvalin, and then we'll take depreciation on that new one, which will offset the gain, so at the end of the day, you end up in the exact same place. But what the difference will be, you will almost, I will guarantee you have to bring that purchase agreement into your tax return, because they cannot do that tax return or calculate that gain without that piece of paper. So a couple revenue raisers that were in this bill. The number one is entertainment expenses are gone. So if you bought rush tickets for clients or for your employees, those expenses are now non-deductible. Can't do it anymore. You can do it, you just don't get a deduction. So this will hit bigger with, you know, places that have skyboxes, stuff like that. This is what they think they were trying to hit. My problem, or my workaround is I'm guessing a lot of those what were entertainment expenses will now be advertising expenses. So, then the next one is very small, but I wanted to put it in here because if you heard it in the news, it made it sound like meals and entertainment expenses were changing, but meals are not. The only meals thing they changed was if you had an in-house cafeteria. So who in here's business has an in-house cafeteria? Okay, then that one really won't make any difference. They, for some reason, just don't like in-house cafeterias. The last one is on research and experimentation, but really won't impact anybody soon, so I'll just let you read that. Interest expense, this one is an odd calculation that I'm guessing they had to put in to just get the bill to balance. So if you are a large taxpayer using that same $25 million gross receipts test that we talked about in the accrual to cash, if you're in that large place and you have interest expense, it gets capped at 30% of your taxable income. So if you have $100,000 of income, you can only deduct $30,000 of interest. If you have a net operating loss, you can deduct zero amount of interest. So essentially what it does is it just creates another carry forward for us to keep track of when we're doing your tax return. And you'll see there's 2 or 3 new carry forwards that get created with some of these disallows. It does carry forward forever, and the only person it doesn't apply to is if you have floor plan interest, so that's auto dealers. But there is an odd rule that if you have floor plan interest and you get out of this, then you can't take bonus depreciation, which is a very odd way for them to put those two things together. There is a new credit for if you provide wages to your employees while they're on FMLA. There's some rules to it that make it a little bit cumbersome, and it's only available for 2018 and 2019, but if you do and you qualify, you can get between a 12.5% or 25% of their wages. So if they are doing, if you pay at least half their wages, they're gonna give you 12.5% credit, and then it scales up if you do more than the 50%. The last one on that page is pretty narrow, so I'm gonna skip it. So the new section 461 L deduction, this one is kind of in the same line as that business interest deduction. So what this one says is you cannot on a tax return deduct an excess business loss. So you'll see here on the screen that this taxpayer had the $1 million W-2, $800,000 loss on the farm, and then made $200,000 in a restaurant. So if you looked at that on paper, they'd have $400,000 of taxable income. But you'll see down below, they're limited to a $250,000 business loss. So $350,000 gets carried forward, and they would have taxable income of $750,000. So it's a really odd rule. If you have a business that has a large loss, you're going to get capped and pay tax and not get that benefit currently. But again, it creates another carry forward for us to keep track of. And the last thing I'll talk about is net operating losses. So net operating losses have allowed for you to carry that NOL back 2 years to get the benefit, or carry it forward for 20. What this rule basically does for most taxpayers is eliminate the two. You cannot carry back either. But the carry forward is now indefinite, so you'll never lose it unless you die with it. So the other rule that sounds bad is the carry forward amount is limited to 80% of your taxable income. So let's say I lost $300,000 in 18, I carry that into 19, and I have $100,000 of income in 19. I can only use $80,000 of that NOL in 19 because it's capped. So I still have to pay tax on 20 grand in 19, even though I have this large NOL carrying forward. It sounds bad, but in the long term, it's beneficial to the taxpayer, because what that'll allow you to do on that 20 grand in 19 is you'll be able to use your standard deduction. You'll be able to use your lower tax brackets. So it allows you on that 20% to capture that low tax bracket. So in the long run, you'll pay less tax than you would have in the past. And I will now turn it over to Jess Weaver, who will talk about the 20% qualified income deduction.
So, I don't know how many of you guys think taxes are exciting, but what I'm going to talk about, I think actually is exciting, because it's a deduction. A lot of what we're talking about has been some changes to how things have been treated, and I'm going to talk about qualified business income deduction that really hasn't existed before. And I think it's going to work out for pretty much every individual in the state of South Dakota. I think it's just a kind of a slam dunk provision. It's not simple. That's the disadvantage. And the deduction's far from guaranteed for business owners. Claiming the deduction requires navigating limitations and new terms of art that the Congress created. So we're still working on what certain things mean that Congress said. We've got phase-ins and phase-outs, and we're going to talk about all that. So bear with me as we kind of go through these slides. To kind of lighten the mood before we get going, these are some jokes that we run around the office from a CPA humor standpoint. So the audit you can be. The last one in there, CPAs solve problems you didn't know in a way you don't understand. If any of you guys work with CPAs, you probably would say that's fairly accurate description of what CPAs do from time to time. So in this new bill, there's a reason they didn't name it the Tax Simplification Act, and that's because it's extremely complicated, especially this 20% qualified business income. Where it came from originally is the 9% DPAD, which is the Domestic Production Activity Deduction, which Congress had enacted, and it was really for manufacturers, construction, incentive for businesses that produce goods and work in the US. So that deduction was repealed. So that at the end of 2017, so that no longer is going to be a calculation that you'll see on any 2018 returns going forward. And this 20% QBI deduction is what I call it, qualified business income, is replacing this. So we'll get into that. So QBI, I'll reference that because it's just a little easier to say than qualified business income. But that it's because was in an infantile state, because it was just formed. We're seeing articles that say it's a pass-through deduction, and the comment that our firm's making is that's a misnomer. It's not really a pass-through deduction. Pass-through implies that it's a deduction only for partnerships and for S corporations, and it's not that. It's a deduction for partnerships, S corporations, but also sole proprietorships, farm and ranchers on Schedule Fs, for businesses, Schedule Cs. So there's a variety. So there isn't a necessity to go to your attorney. Sorry for the attorneys that are in the room, but yeah, you don't have to go to your attorney and design a new entity just to get this deduction. Usually, if you're already functioning in sole proprietorship, you don't have to change that for purposes of qualifying for this. We're going to get into what qualified income is, but it's a deduction. It's not a credit. And just to make sure everyone understands that, a deduction is kind of like an expense. It offsets your income, where a credit is a dollar for dollar against the taxes that you owe. So if you get a $20,000 deduction, and it wouldn't mean that you get $20,000 back. It lowers what your overall taxable income is. And that's the difference. So this is a deduction. There are some limitations to it, and we'll go through those. Really, those limitations are all for high taxpayers, is how they would distinguish that. And high taxpayers are if you're a married couple, it's $315,000 of taxable income, and that's not your adjusted gross income, which is, if you look at your 1040 personal tax return, the front page on the bottom is your adjusted gross income. And that's not the number that this is calculated from. It's calculated on the back of your return after your standard deduction or your itemized. After all that, you hit your taxable income number. And if that's under $315,000, you don't run into any of these limitations related to wage and property or the type of business you are. So, for most taxpayers, this limitations are kind of a new point. Below line deduction, that's just referencing that it's on the back page and it's not on the front page of your return. And it doesn't decrease your self-employment income. So if your income from a partnership, guaranteed payments, or you have a Schedule F or a farm return that's making money, or a sole proprietorship Schedule C business that's making money, this doesn't decrease that self-employment income for purposes of self-employment taxes. So S corps are still extremely valid from that standpoint, because that's usually why people pursue those. And we'll get into some kind of details and planning points related to. So section 199 is the code section that you'll find. So if you guys are, there's no sports on TV and you're tired of reading the news, you could look up section 199 and IRS code and read through the regulations on QBI. But I'd encourage you to just take my word for it. Qualified businesses, and that's all businesses that aren't C corporations. So C corporations pay their own taxes, and the QBI deduction doesn't apply to C corps. And I'll get into the reason for that when I talk about C corporations, but it includes everything else. So partnerships, S corps. It also includes trusts. So if trusts have interests in a variety of partnerships or items that they qualify also to get this deduction. And how it's calculated, it's calculated on each individual return, or each individual entity. So in this scenario, the S Corp, LLC, both LLCs in partnership, on those K1s, you will see that the preparer will need to report what the qualified business income is. They will communicate what the wages will be, and the reasons for that I'll show you. But the deduction is taken on the 1040 return. So the deduction isn't taken at the business level, it's taken on the personal level. So if you have 4 or 5 partners in a partnership, each of them will get their pro rata share and it'll flow into their personal return, and that's where the deduction is calculated. So let's go over a really super simple example of this. In this scenario, the qualified business income is $100,000. And so the 20% is what is deemed to be the calculated amount of the QBI. So the deduction's $20,000. Now, if you look, the tax rate in there, I have it marked at 37%. And the reason I selected 37% because that'll be the highest tax bracket. So this is under the assumption you're making you're making more money than there is, I guess, the highest bracket you could possibly be in for income tax purposes. In that scenario, if you qualified and you got 20% on 100,000 at a 37% rate, the tax credit equivalent is $7,400. So actual money in your pocket savings is $7,400. So we look at that and we say, okay, you save 7.4% on 100,000. So that lowers the overall tax rate from 37 down to 29.6, if you guys are following me. So if all your income was subject to QBI, essentially the highest tax bracket would be 29.6 and not 37. So just a simple deduction or a simple calculation. So what qualifies for the 20% deduction? Well, qualified business income, which we'll get into that, REIT dividends. So those are real estate investments. You receive those on a 1099 at the end of the year. And publicly traded partnerships, which as CPAs, we do not like seeing publicly traded partnerships because they're a mess putting them together and keeping track of them in returns. But they are tax-favored investments. So for investment advisors, both REIT dividends and publicly traded partnerships qualify for this QBI deduction. So you can make money and qualify for a deduction at the same time. The last one in there, co-op dividends, allocations. This is what we have been told, and as you read through the bill, this is one of the most complex parts of the bill itself. We're not going to get into this because it would take up the rest of the night. But it's almost too good to be true for farmers that work with co-ops. And we actually are seeing like Cargill that competes with co-ops. They're trying to get this thrown out because it's going to lower the number of individuals that are going to want to work with them because of the benefits that the farmers get above and beyond the 20% deduction. So that really is for anyone working with co-ops, and if that is a scenario or you know someone with that, they'll definitely want to look at tax planning and have a conversation with the CPA about that. So QBI, here it is. What is it? Well, it's all ordinary income. The most simple way I could describe it is ordinary income less your ordinary deductions earned from a sole proprietorship, partnership, or an S corporation. So it's from a qualifying trade or business. That's one of our questions for the IRS is what is qualifying trade or business? Really, it would be a smell test of is this a business or is it not? Is it regular and substantial? Right now it's kind of a blanket reference, but really if it looks and smells like a business, probably is going to fall into this category of it being a qualifying trade or business. There are some exceptions to this, and those are for QBI, wages don't come into play. So on your 1040, you have wages and you also have income from maybe K1s. from various entities and Schedule Cs and stuff, your wages don't qualify for this deduction. Neither do guaranteed payments, which are the partnership payments in lieu of wages, and then certain investment income. So in there's long-term, short-term gains, dividends, commodity income, and some others that aren't on this list, which would be IRAs, Social Security, pension. None of that stuff qualifies for this deduction. Only qualifying trade or business activity. But what it does include is rental income. And there's a big, big question mark of if that is absolutely true. We think, based on when I get into some of the limitations, it's pretty clear, but at what point does something become qualifying trade or business, or is it extremely passive? It has to rise to the level of a trade or business. So if you're invested in some rental activity, and it's across the other side of the state, and there's a triple net lease, and you just pretty much receive checks, and that's all you do related to the rental activity, it may not qualify for this. That is one of the things that we need some provisions for. Now, if it's a residential house that you're doing work for, and you're filling the tenants, and you are fixing the plumbing, and you're paying the real estate taxes, those things, then it would qualify for the QBI based on how we've read the regs. So that's another one, but we're confident that at least some portion of rental activity is going to qualify. 1231 gains qualify, and those are business assets, would also be cattle, and then royalty income, which is pretty unique because royalty income around here, you got oil and gas, so all that income qualifies for QBI. An area that I work in quite a bit is franchising, so territory developers that receive royalty rights at developing areas for franchises, that royalty income all qualifies for QBI. That's definitely an advantage. So 1040 calculation. The deduction is the lesser of 20% of the QBI, which was the scenario that we went, subject to wage and property limits, which we'll get into that, or 20% of the excess taxable income minus your net capital gains. So it takes your taxable income and you take out all your capital gain income, and it's that 20% of that. So it's the lesser of those two. So they aren't going to give you 20% if a lot of yours is capital gains. You're going to have very minimal QBI. But it's the deduction of the lesser of those two. So capital gains, obviously that would include dividend income. And this is where some of planning points can come into play between the years and what the impact could be. So let's look at an example of that scenario. So in this example, you have 3 K1s, a Schedule C, so priorship business, and a Schedule F. And the 1040 shows 130,000. And assume that's all QBI activity. 20% of that would be $26,000 deduction. But the taxable income limitation, you take the 150,000 and you have to exclude the net capital gains, and so from that scenario, you drop it down to 110, and there's some variance between the Form 1040 taxable income on one side and taxable income on the other. Part of that can be because of your itemized deductions, because remember, taxable income comes into play following, the deduction comes into play following all your calculations for itemizing. So in this scenario, if you just took the QBI, you'd only get 26, but you have a limitation because of capital gains elsewhere, and so that would drive it down to 22,000. So when Kevin was sharing, he talked about how there's all these carry forward schedules. Now, I think you named 4 carry forwards on top of what we already have. And this is another one. So in this scenario, if you have 1 year where your QBI results in a negative number, so you take a large loss on a K1 and you don't have income in that year to offset it, that QBI deduction loss would carry into the next year. So if that K1 had 100,000 in it and you go into the next year and now you're showing a $50,000 profit on that K1, you don't get 50,000 for the calculation. You have to take what the carryover of unused loss from the previous year and apply it. So you can see in this scenario that the carryover just adds to the next year and to the next year. So if you take the large losses in a couple years and it's all qualified business income, then it'll eat up future years of profits. So that's a planning point too when we start looking at rental activities. A lot of rental activities show losses because of depreciation and determining would it be advantageous for these to be qualified as QBI or not. Because if they're lost, they're going to decrease your overall deduction. So you know, if you had lots of rental activities and you're on the fence if they should be or shouldn't be, maybe it's advantageous to not include them in QBI so that those losses don't eat up against income that maybe you could save some taxes on. So another limitation that I wanted to talk about was wage and property limitation in QBI. This limitation doesn't matter if your income is below $315,000 married filing joint. You can just scratch all the limitations, they don't matter. If you make more than $315,000 married filing joint, there's a phase out, and it's on the next slide, of how much benefit you'll get, and then at some point, then you're strictly in these limitation calculations. So as we go through these, just remember, if you don't make $315,000 married filing joint, these limitations don't matter. If you do, they become very big in the process of planning to make sure that you get these deductions or maximize them. So the first limitation is the greater of 50% of your W-2 wages of a business, or 25% of the wages of the business, plus 2.5% of the original cost of qualified property. So the first one, in that first scenario, 50% of W-2 wages, that's really easy to calculate. You know, you look at the W-3 and 50% of those W-2 wages, and there you go. The second scenario, 25% of the wages plus 2.5% of the original cost of qualified property. And this is where, you know, one of the reasons we look and say, well, rental activities is going to include in this. Because how many rental activities have wages? You don't see wages in rental activities regularly. So in these scenarios, for them to be able to benefit from real estate, they put this caveat in there of saying, or 2.5% of the original cost of property. So what qualified property is tangible property that you can depreciate. So land isn't qualified property, buildings are qualified property, equipment's qualified property, inventory is not qualified property. So that 2.5%, and we'll look at an example, is based on the original purchase price. And you can either do regular depreciation method, so of a piece of equipment, the life on that's usually 5 years. So they would qualify for either option of 10 years or the life of the equipment. So in this scenario, say you have equipment that's 5 years old, and you're in year 6, you would elect to do the 10-year option as opposed to taking the 5-year for purposes of that meeting this qualified property rule. Same with buildings. Buildings are on a 39-year life. So to get 2.5%, you would obviously use a 10-year. you would be able to use that building for 39 years for purposes of taking 2.5% of that building for this calculation. So it's not from when you started, it's when it was purchased. So when we look at this scenario, maybe it'll make more sense. Now this is a planning point as well, because we've been taking capitalization policies, and how much stuff do we just write off? You know, it's $2,500 is the max cap policy. It might make sense to drop that to $1,000, start putting on more equipment if you were making more than $315,000, because it may make sense to where you start tacking up on this equipment, things that you usually just expensed, now you capitalize it. And the same with 1031 exchanges. Kevin referenced that in the past, when you do a 1031, usually it was just the net difference of what you paid in cash would go on your depreciation schedule. Well, now it's the full piece of equipment, the value of it's going on the schedule, which you can use for the 2.5% original cost. So a couple things in there that, you know, even if you're not at that income level now, but you know, like I'm close to the bubble, and maybe in 4 or 5 years I reach that level, it would be advantageous to begin recording some of these things on the depreciation schedule now, because it may be more beneficial down the road. So this is the phase-out limitation that I was talking about. If you're under 315, you don't care about any of this stuff, unless you think you're going to be close to that level. From 315 to 415, you get a portion of it, a portion of the 20%, and then a portion of it goes based on this calculation. So it's kind of a mix. Once you get above 415, you have to calculate it all based on these two, and you don't get any additional phase out. So that's related to the income, or I'm sorry, wage and property limit reduction. So here's an example. Wages of $100,000, and this would be in a business. This isn't on your personal return. This is in a business, because these are calculated business by business. Wage of $100,000, cost of qualified property, we'll assume that's a building of $500,000, and that's not land, that's just the building. So it's the greater of 50% of the wages, which is $50,000, or 25% of the wages, which is $25,000, and 2.5% of the property, which is $12,500. So in this scenario, 50% of the wages makes way more sense. But if you don't have any wages, then 2.5% of the property, of all qualified property, could be a big deal for the deduction. So the wage limit, like I said, is calculated on the 1040, and as preparers of the return, we have to go through each of these qualified business income activities and, you know, per entity, and calculate this and include it on the K1 of the return. So if you don't have them on your K1, there's no way that you're going to be able to input what potentially you could get for a deduction. So you can see on a 10% ownership, wages of $50,000 and property of $200,000, you would see that the accountants would allocate the share based on your ownership percentage, and those will be in there. And that's what allows preparers of personal returns to be able to figure out the deduction for this K1. The other limitation is service businesses. Again, I'm hammering this. If you're under $315,000, you don't care about these. So if you're an attorney, or you are in accounting, or you manage broker services, and you're under that number, these limitations don't apply. So this service businesses, we expected to kind of follow along with personal service corporations, and the government didn't do that. They kind of expanded the scope within the field, and so you can see services in these fields. So this is an area where we need some regulations too, because services in these fields, now for health, it's pretty easy. You know, physical therapist, that'd be easy to say you're in that component of the health department. But a hospital, you would have said, wouldn't be a personal service corporation, so it wouldn't have fallen under these regs. But how this reads, it does. So hospitals, pharmacies, and interesting scenarios like a Walgreens, where they have a pharmacy in part of their building, Now they'll have to do a calculation on the portion that's subject to these and the portion that's subject to, that's not part of the service business. So we'll be seeing some regs come out, same with law. Conversation attorney obviously is, but as a court reporter. I mean, that's in the field of law, but, do they qualify or don't they qualify? And then, as you go, I could hash out each one of these, but I think I'll wait till we get some regs, just to know that there's a lot of questions related to that. And at the bottom it says, or any business where principal asset is the reputation and skill of one or more of its employees. And this was something that Congress put in there that's actually pretty smart, because what would have happened is you'd have an executive, say you have a manufacturing company that takes $1 million W-2, and he would have said, okay, I'm going to incorporate myself and work a contract with the manufacturing company, because my W-2 wage doesn't qualify for QBI. So I'm going to incorporate, start an S corporation, that I'll be a consultant for the manufacturing company, and then that $1 million will come into the S corp. I'll take a $200,000 wage, and the other $800,000 now qualifies for QBI. That's not going to happen because of that last sentence in there. Any business where the principal asset is the reputation and skill of one or more of its employees. So consultants fall into that line. There's things that we also don't know. The scenario that Rapid City used was professional hairstylist. So if you go to one specific person, because that's who gets your hair and that's where you want to go every single time, they have a skill of that specific employee. Whereas if you go to cost cutters and you don't really care whoever cuts your hair, there's a difference in that scenario. Now, if you're a hairstylist and you're making over $300,000 a year, I would say that you're doing pretty good. And maybe I should start that profession, so let me know. But a couple that we would have expected to be here and aren't are engineers, architects, and they were intentionally left out. So we concluded that they just had better lobbyists than the rest of us, and they got excluded for purposes of this limitation. So same scenario here. It's the phase out starts at 315. So if you're in any of those professions, when you hit 315, then we start dealing with this phase out. When you exceed 415,000, then as a business you don't qualify for any QBI if you're in any one of those service businesses. Got my slides mixed up here. So some planning points. And this is big, because if you're under 315, you get all of it. But if you're not, then you start dealing with these phase outs. So playing with taxable income, remember it's based on taxable income, not your adjusted gross income. So when you start looking at charitable deductions, you're itemizing on your personal return, that could drive that down. But it also could drive it down so much that you don't get any benefit whatsoever of the QBI because your taxable income is now so low. So that's something to look for that all cash basis taxpayers need to be aware of. Reduced wages. And that's on there because of S corporations. We've played this game forever where S corporations, what's a reasonable wage, not taking more than that. Well, this just adds to that because if you take a high wage, that wage you don't get any QBI deduction for that. So if you lower your wage and you leave more on your K1, you get that deduction on there. So we have the phrase, pigs get fat, but hogs get slaughtered. And the government looks at reasonable wage. It's always been a test, and it's just going to even be more so now from a watchdog standpoint, because if you do reduce your wages, you even get more benefit from just saving on payroll taxes. Service businesses could increase rent. So reasonable rent between your business and maybe a rental property or that the business works in that you own. Maybe you increase the rent activity in that. Needs to be high, but also reasonable. So converting subcontractors to employees. And that's important when we're looking at the wage calculation limitation, because if you don't have any employees and the limitation is 50% of wages or 25% of wages plus 2.5%, if you convert some of your subcontractors to employees, and this is in certain industries, and it needs to be legitimate, but like roofing industry, where you get a lot of subcontractors, if you hire some of those and you give them a truck, and you provide their tools and you pay them, maybe that would allow the opportunity for you to get the QBI. Guaranteed payments versus a draw, this would be for partnerships. So if the partnership agreement has you taking guaranteed payments as your compensation, maybe changing the language in the partnership agreement, and my attorneys in the room could call me out if I'm wrong, but I believe the Fifth Circuit allowed that. And so if you change the language in the partnership agreement that say, hey, we're taking the profits instead of the guaranteed payments, then the profits all qualify for the QBI, but where the guaranteed payment doesn't. Married filing separately, that would be depending on where income levels fall. So if one individual is making a lot of money and where it's killing the QBI deduction for other activities, we don't, at least I'm not aware of yet what the regs say, or if there's guidance of how they're going to calculate this between a husband and wife, and who owns what, and if it's going to be individually specific. So maybe married filing separate for those purposes would be beneficial. Another option, which I did put it on there, but I thought of it because things are still unfolding since we made these slides, but C corporations, you could, if you remember, we looked at the list of service industry that the limitations met. And if you had significant rental activities that would have qualified for QBI, but you're in a service industry, maybe you, what's driving your overall wage too high, maybe you look at converting that service business into a C corporation. And so because that C corps don't qualify for QBI, but that service industry doesn't either, so it wouldn't be necessarily a loss of QBI. And that's something that would need some clarity on, but throwing it out there as a potential idea. So that's it for QBI. And I hope you guys were able to follow along with me. Just got a couple slides on corporations, and then I'll turn it over. Corporations, this was one thing that Congress has been pushing for a long time, is changing the C corporation tax rate. It was at 35%, and they did this because they think it's going to pump the economy. So they dropped that down to a 21% flat tax when they repealed the A&T. And you would say, well, why don't I just move all my income into a C corporation? And I'll look at this example, and I'll be done with that. So say your C corporation makes $100,000. Flat tax is 21%, so $21,000. And then you take the rest out as a dividend. So that dividend, in this scenario, we assumed it was the highest tax rate. So that dividend's reported on your personal income tax return, which was the highest rate available is 23.8%. So total tax between the two of those would be 39.8%, almost 40%. And this is a worst case scenario. Obviously, if your taxable income remained in the lower bracket, you can get the dividends tax-free. And that's a game to play. C Corps, I think, are more on the table now than they were previously. And there may be excellent reasons to pursue a C Corp. If your business is flat, you can control where the income is. If you're planning on not taking the money out of your C Corp because you don't need the dividends and you're wanting to grow this business and expand, then you're going to keep the cash in, so you're not even going to deal with the dividends. All you'll have is the 21% rate. So that would make sense. And then I also talked about the service business limitation, and that may be another reason to look at it. So with that, all that exciting information, I'm gonna hand the mic over to partner Jennifer Konvalin, and she will crank the pump even more so with the next changes.
Thanks, Jess. Okay, so today is National Do Nothing Day, and for the last hour, I don't feel like anybody here qualifies for that. So, we're gonna move away from the business stuff, get into some of the personal information here, which is definitely going to apply to everybody in the room in case there were people who weren't business owners here. This first bracket, my poor marketing department, I was really through it, taking their plans here because I had them do this as a whole separate slide, because I found it much more efficient to have this presented side by side for both the single and the married filing joint rates, and if we'd done it any smaller, you guys wouldn't be able to see it. So, what you're looking at there is on the left, you will see what the tax brackets would have been for 2018, and with the new law, what they are going to be. The Senate version 1 here, there was a lot of news coverage about 3 tax brackets. You know, we were just gonna have those 3 tax brackets, simplification, postcard tax returns. Does anybody feel like we're getting towards postcard tax returns yet? So we didn't really see that, the Senate version 1 here, and essentially we came out with 7 brackets still, like we used to have, and the brackets ranged anywhere between 0% reduction up to possibly 4% reduction if you look at those brackets. Your 10% bracket, you'll notice, in both the single and the married filing joint categories are both still 10%. Income levels exactly the same. They did not touch those brackets. Your 15% bracket became 12, so it reduced by 3%. And the one thing that it did help, that the new tax law did help, is between what is now the 12% bracket and the 32% bracket, they eliminated the marriage penalty. You may have heard about that some already, and you'll hear about that a lot as I go through things. The marriage penalty essentially says there's been a lot of things in tax law, especially here of late, where the married number is not double the single number. And so they did fix that in the new tax brackets for most of these tax brackets, not quite all of them, where you'll see, you know, for example, the 22% in single goes up to $82,500. On the married filing joint, it goes up to $165,000. That did not used to be the case in the old brackets, so they did help the marriage penalty in some of those. You'll notice they had a big marriage, they still left a big marriage penalty though in the top 2 tax brackets, the 35 and 37%. The 35% on the single tax filer goes up to $500,000. On married filing joint goes up all the way to $600,000. So we only got an extra $100,000 on a married joint return there. I've been telling my husband for years, the kids don't have to know. Everything else can stay the same. The 37% bracket, again, $500,000 for a single return, $600,000 on the married filing joint. So they didn't completely fix it. It is important to note, I think, that there was no change in the capital gain rates. So for those of you who knew what those rates were, in the lower 2 tax brackets, still 0%. If you go over those top 2 tax brackets, still 15%. The Obamacare surcharges, or the ACA Affordable Care Act surcharges, there was no change to those. Those are still in place. So if you hit that highest tax bracket, you still get to pay the extra, you go up to 20% on the capital gain rate. Plus then if you're in that highest tax bracket, you're also paying that extra 3.8% on the unearned income. So your capital gain rates did not change. A couple of planning points. If anybody is really close to the to being just over that 22% bracket, okay, on a married joint return, say your taxable income is $175,000 instead of $165,000. This is all based on taxable income. Maybe you should fund an HSA if you have a high deductible account. Maybe it's time to fund IRAs, personal IRAs, if you qualify to fund those, because dropping yourself down into that lower tax bracket and getting down into the tax bracket below that is really going to help if you have big capital gains then, because you don't pay any tax on those capital gains. That's not a new planning point necessarily, it's just new brackets. Another thing then to note, when I did this presentation last week in Rapid City, I said we were still waiting on new withholding tables. They told us they'd be out by the end of February. Anybody watching the news, IRS released those on Friday. There are new withholding tables. You can find those on irs.gov. You're going to see here in a few minutes that we lost personal exemptions. And so the old W-4s, for anybody who's an employee or has a business and you have employees fill out those W-4s, you'll notice that it asks how many exemptions. I don't know what the new W-4s are gonna look like yet, they haven't released that. They have released new tables that are supposed to work with the old ones. But they are releasing new W-4s, and I don't know what those are gonna look like, because personal exemptions have now gone away. We do recommend, the tables are out, the IRS has said you should be using those no later than February 15th, or as soon as possible. Most of us are gonna be held up waiting for our software engineers, programmers to get that, loaded into our software, make sure you download those new tables. And tomorrow, probably, I'll have information to that, you can check the blog post that will be on our website and Facebook feed, a quick blog on this as well. Okay, so comparisons of tax savings, I'm not gonna spend a whole lot of time on this, it was just kind of something interesting I felt like for you guys to look at, that you could kind of see, what does this mean for me? You've heard a lot about, in the media here the last couple of days especially, I've heard a lot of people saying, everybody's gonna see a little bit more in their paycheck, they're gonna take home a little bit more every time. That's because a lot of those tax rates and tax brackets went down anywhere between 2 and 4%. Not quite all of them, but a lot of them. So if you're curious, what's this mean for me? If your married taxable income is, say, $75,000, you might see, a $1,500, $2,000 reduction, barring other changes in what your overall tax bill was. So that's why they're saying everybody's gonna see more in their take-home pay, because these new tax tables are going to make up for these new tax rates. They also said that they tried to do a better job with these new tax tables. I'm not sure why they're just now figuring this out, but they tried to do a better job so that there isn't over or under withholding on these new tax tables, trying to get people kind of closer to zero. So that's more just informational if you're curious about you. Okay, so let's talk about your standard versus your itemized deductions. As Jess said, deductions, different from credits, and I'm gonna talk about both. But the big news that you've been hearing, standard deduction doubled, didn't quite double, they can't do math very well. We went from 13,000 to 24,000 on a married filing joint return. But they came close to doubling. The other thing I've been hearing, which is another misnomer, great, now I'm losing all of my deductions. I'm not gonna get those deductions anymore. You get the higher of your standard or your itemized deduction. So really, you're not losing deductions. Your standard deduction on a married return has gone from 13,000 to 24,000. If that is higher than the total of all of your itemized deductions that we'll look at here in just a minute, you're gonna get the standard deduction. So you don't get to take those itemized deductions any longer, but you really didn't lose them, because you're still gonna get more in the standard deduction, okay? There was a little bit extra in there too for the elderly or blind. At age 65, or if you're legally blind, there was no change to that. The other thing that you'll see here is they also, marriage penalties not in play here, so 12,000 for single, 24,000 for married filing joint. Head of household is 18. Okay, so you get the higher your standard or itemized deductions. What counts as itemized deductions? There's quite a few changes here to itemized deductions. And I think only the military is probably worse at using some of the acronyms than accountants. So we try not to use a lot of acronyms, but we can't help it. We just can't help ourselves. But I am going to cover a couple here because I think you've heard it enough that everybody's pretty familiar with it. Qualified medical expenses. This is one of the 3 things in this tax law that actually goes back and affects 2017. That had gone up to 10% of your AGI or adjusted gross income. That's total income on the bottom of your page, page 1, 1040. Used to be 10%. You had to get over 10% of your AGI. So if your AGI was $100,000, you had to have more than $10,000 of medical deductions to get the medical deduction. So if you had $12,000, you'd get a whopping $2,000. Okay, the first $10,000 got lost. They cut that back to 7.5%. For years and years, it was 7.5%. 2017, 2018 only. In 2019, it goes back to the 10%. Honestly, folks, about the only people I see take this are those who are in nursing homes, assisted living homes, that kind of stuff. So not really a huge deal for most people. SALT, one of our acronyms that we love. State and local taxes is what that stands for. Okay, this is one of the things that you heard at the end of the year. It was all over the media. We had a couple congressmen pretty upset over this. All of your people on your coastal states, your East Coast, your West Coast, they hated this. Okay, there was some talk about eliminating this altogether, but in the final bill, as they reconciled it, what they came out with was a maximum of $10,000 deduction. For South Dakota residents, for most of us, this doesn't affect us greatly. Why? Because we have no state income tax. So your coastal states hated it because they have high state income tax. And your SALT deductions, your state and local taxes, include state income tax, or sales tax, whichever is higher, which is what most people in South Dakota are taking, is that sales tax deduction. And then the other thing that it counts is gonna be your property taxes, and in a few places, some personal property taxes. Doesn't count in South Dakota. I do have a couple clients in Nevada that take that, Wyoming gets it, things like that. So maximum $10,000, okay? So let's take a standard scenario. Your sales tax deduction is going to be those major things, like we always ask. I usually look at the guys in my tax appointments here and I go, what kind of new toys to get this year? New cars, new boats, those types of things. You pay major sales tax on things, and then the table on the IRS's infinite wisdom, this is how much you made, so of course this is how much you spent, times the rate where you live, and you get that standard amount for your sales tax deduction, okay? Then we're gonna add to that property taxes. So I did have quite a few clients who went and paid their property taxes on the last day of December, on December 29th. Everybody had a rush on the Pennington County Courthouse, paying property taxes. I'm not sure what yours looked like here, but it was all over the news down in Pennington County. So they were all running to pay the property taxes. Because if your property taxes then, if let's say your sales tax on average is running $2,000 on your return, if your property taxes are $10,000, we do pay a lot in property taxes. Because we have a state with no state income tax, they have to make it up in other areas. You're gonna lose some of that property tax deduction when you look at the total of this $10,000. Okay, so that's why we saw that. What else qualifies then as itemized deductions? The mortgage interest deduction. So we're gonna take your medical expenses, if you have any that qualify, we're gonna add to that your state and local tax deduction, and then your mortgage interest deduction. So for those of you who still have a mortgage on your home, you're gonna get to deduct that. Now, if that mortgage was already in existence, you still qualify under our old rules, but there were some big changes here, okay? The old rule said up to $1.1 million, essentially. It really said $1 million of mortgage interest indebtedness, plus $100,000 of home equity. But they were pretty loose on that home equity, so really we were able to go $1.1 million for most people on mortgage indebtedness. If your mortgage was done before December 15th, those rules have not changed for you, as long as you change nothing else with your mortgage. You have to be very careful if you refinance or you make any other mortgage changes, or you're easily gonna slip into the new rules, okay? Your new rules, home equity, no longer deductible. So we automatically, even under the old rules, you're automatically down to the million instead of the 1.1. Home equity is no longer deductible. Now, that does not mean if you used your home equity loan for maybe some business purchase interest and things like that, we can still take it there. We may need to make an election with your tax return to be able to trace that to where it specifically went. But we may have had a lot of people who might have gotten a home equity loan, bought in cars, things like that with it, and we were able to deduct it. That is no more. If you refinance, you have to be really, really careful here, because the new rule says that for new mortgages, it's limited to $750,000 of mortgage indebtedness. No longer the $1 million limit. Again, in South Dakota, not going to affect quite as many people, because a $350,000 house here is a $1 million house in San Francisco. So for a lot of people, it may not affect us here, but it could very much come into play. There's a time frame in there between December 15th and April 1st on if you had a contract in place but didn't close, that kind of stuff. It's a very small window. If you think that applies to you, then talk to us and we can go over that with you. Let's talk about the refinancing. If you refinance, as long as you don't take any more money out or extend the term of your loan, you can still qualify under the old rules. But if you do either of those two things, then it automatically kicks you into the new rules, and you're limited to the interest deduction on $750,000 of indebtedness. Okay, so let's take a look at a couple of examples. Sorry, I was behind on my slides there, to help show what we're talking about here. So I've got the same facts for you. John and Jane have a loan to purchase their home. It started in 2015. For $650,000, so they have 27 years left, because we're now in 2018. Before, all of their interest was deductible, no problem, no issues with that. Let's say they refinanced their home on June 1st of this year, solely to get a better rate. Okay, they were paying 6% for some odd reason. They had a terrible banker in 2015, but they're gonna get a new rate, 4.5%. So they refinanced their loan to get a new rate. But I don't know very many mortgage companies or bankers who give you a mortgage for 27 years. So they get another 30-year mortgage. That automatically, because they now went back to a 30-year mortgage and they had 27 left, kicks them under the new rules. Okay? Fine in their circumstance, because they didn't get any money back, they're still under the 750, not a problem. But they are now subject to the new rules. So let's look at question B then. They refinance their home, same time frame, and they get $150,000 back for the remodel of their home. Because it's the home that is registered with the deeds, on their deed with the county, that it's for that home, they are going to be under the new rules, and so they can go up to the $750,000. Because they got the money back, they're on the new rules, they can go up to the $750,000, but they're gonna lose essentially the interest deduction on $50,000 of that new debt. Even though they used it on their house, because they're kicked under the new rules and they're now at $750,000 of indebtedness. Let's look at number C. They refinance their home on June 1, and they get $100,000 back for a down payment on a rental home in Arizona. We may or may not have a number of clients who snowbird. And they started with rental homes a lot of times down there. That might turn into their second residences as they retire. Because they take that money, and that money was used for a home that is not what the mortgage was for, and not what the deed is filed on for the county, that extra $100,000 will not count. They cannot deduct that as mortgage interest, because it has to be used on the principal residence. So no more of doing this and using it for the other home. But we may be able to make the election, or if they had a home equity line, and there may be an election that we can make then to trace that to the second home, as long as it was rental property. If it's purely a second home, probably not. Again, there's a lot of things we're waiting on some regs on. We're gonna get some more regulations, some more clarifications. Some of this stuff, we may be 5 years out waiting on court cases before we know exactly how this is gonna affect everybody. The fourth one there, then they refinanced their home. They said, heck with it. They were at the presentation tonight. They didn't like any of the information we gave them. And they said, heck with it. We're going to retire, and I like to fish. And they get $100,000 back when they refinanced their home, because they went and bought a new fancy boat and they didn't have a truck to pull it and they needed a truck to. That extra $100,000 won't be deductible because it's not on their principal residence. Okay? Clear as mud. Okay. So your next itemized deduction is charitable donations. That did not change, with the exception of, I do have a couple of clients who used to hit, there was a $50,000 of adjusted gross income limitation on charitable deductions that got bumped up to 60%. So I do have a couple of clients who will like that. They give away a lot of money, very charitable every year. Otherwise, your charitable donations did not change. Miscellaneous itemized deductions, suspended. They are not there anymore. I have a few clients this affects greatly. You have some businesses where they are essentially an employee for the company, but they have a lot of expenses that they pay for. They take clients out, they're wining and dining those clients, they're doing a ton of, they're holding seminars like this, and they pay for all the food, those types of things. Those were all unreimbursed employee business expenses before that fell here under those miscellaneous itemized deductions, no longer deductible. MAP fees is your managed account plans. For those of you who might be financial brokers or work with financial brokers and you don't pay commissions, you pay a managed account fee, that's where these were deducted, no longer deductible. A big one could be attorney's fees. And here's a terrible example of attorney's fees. The only settlement that is not taxable is personal injury. So any other settlement that you get for attorney's fees is taxable. That goes on page 1 as income. And if you had to give 40% to your attorney then, because they took your case on contingent and that was their fee, and you gave 40% of a $100,000 settlement to your attorney, $40,000, this is where you would deduct that $40,000. It's gone. So you're gonna pay tax on $100,000 of income and you only got 60. Okay, so this could be a big one. And that's not necessarily good news. Your P's limitation was suspended. The P's limitation was a reduction of your itemized deductions for high income taxpayers. Some of you may have never seen this before, others of you might be intimately familiar with this limitation. For those of you who are high income taxpayers and you were losing some of your itemized deductions because your income was too high, that's been suspended again. It was suspended back in the Bush days, came back in the Obama days, and now it's suspended again. So for those of you high incomers who are suffering from that, you will no longer lose that those itemized deductions. So this could be good for you. So what can we do with this? Some good planning items. We take all of these things and we add those up. Your medical expenses, your charitable donations, your mortgage interest, your state and local tax deduction. And if those equal more than your standard deduction, you still get to itemize. So you're still not losing your deductions. Okay? I have a lot of high income taxpayers who used to go, should I donate? And with the P's limitation, I used to go, a lot of it gets suspended. Don't do it for the tax write-off, do it because you have a cause, because you have a good heart, whatever that may be. A good planning tip though might be, we might have a lot more people bunch their deductions. Maybe you're gonna fall at $22,000 with what you normally give to the church and a few other things you do, your mortgage interest, your property tax deduction, and you go, now I'm not gonna itemize anymore when I used to because now it's at $24,000. Might be a good time then to start doing some more bunching of deductions. We can't really do the property taxes as much anymore because those are limited, but you could do your charities for 2018 in January and December and not do them then in 2019. Still get your higher standard deduction in 19 and really boost up those itemized deductions in 18. Get to $40,000, $50,000, $60,000 instead of 20. Okay, so we may see a little bit more of that. The things that they didn't touch, the gambling, there was a little bit of news about gambling and that got suspended. It really didn't. There was a couple of things that I've never really actually even seen a client use that got combined, but that shouldn't really affect other people. Another good planning point for those of you who may not itemize anymore and get the benefit of those charitable deductions, if you're 70 and a half or older and you're getting RMDs, you can still do those RMDs or required minimum distributions direct to charity. That's a great planning point for anybody, even before the law change. It doesn't come into taxable income. You didn't get the deduction on the other side. Now you may not anyway. So it might be another way to transfer that money. Counts as your RMD or your required minimum distribution payment, but you don't have to take it in taxable income. Okay, the last few things. I'm surprised the personal exemptions didn't get more news than they did because media, bad news sells. Personal exemptions are gone. This is bad for someone like me. I'm married, I have 3 kids at home. That was $4,050 per person. That's $20,000 off of my return I no longer get now. So my itemized deductions fell just under the standard deduction limit. I'm gonna get a little bit more in my standard deductions, and I lost $20,000 of personal exemptions. This line where this used to go, we think is where the new 20% flow through is gonna come in. So I'm hoping that the accountant lobbyists get better. Personal and casualty theft and theft losses, those have been pretty much suspended unless it's a presidentially disaster declared zone. Roth IRA recharacterizations, a pretty narrow focus really, but this was a huge planning point. I had a couple of clients this was a big deal on. You used to be able to have until the time you filed your return, including extensions, to go, never mind, I don't want to do that. Because when you convert money from a traditional to a Roth IRA, it all becomes taxable. And you used to be able to see your tax bill and then decide you didn't like that answer and undo that. You can no longer do that, so you got to make a good choice in the beginning there. And then the ACA individual mandate penalty was repealed. This is the only part of the Affordable Care Act that is touched in this law. And that is the individual penalty that people paid for not having insurance. That doesn't happen until 2019, so you're still going to pay in 18 if you didn't have insurance. In 2019, it is repealed. But the other Obamacare surcharges that I talked about, your 0.9% on earned income, 3.8 are all still there. None of that other stuff was touched in this law. The child tax credit, dang it, I said last week, I gotta get a thank you card out to Marco Rubio on this one. This was his deal. This was his standing block. Wanted the child tax credit doubled, and that's what we see. $2,000 instead of $1,000. And again, this is credit dollar for dollar off your tax. Not a deduction like we were talking about with your itemized or your standard deductions, dollar for dollar off your tax. If you have kiddos under age 17, you get to take a $2,000 deduction instead of a $1,000. It used to be refundable up to the $1,000, and what's that mean? If you, after all of your personal, well, you don't get personal exemptions anymore, after your deductions and your QBI deduction, if you have no taxable income or no tax due because of anything else that was happening, then you could still get refundable back that $1,000. That has been moved up to $1,400. Okay, so that's money that you never actually paid in, and you can get that back. So increase the refundable portion. A big change here is that they increased the income phase out. It used to start phasing out at $110,000 married filing and joint. It now starts phasing out at $400,000. So that's a huge increase. There was a lot of people who didn't qualify for this because the phase out was so low. You'll also notice that they eliminated the marriage penalty in those phase outs as well, because it used to start phasing out at 75 for single, 110 for married filing and joint, and now it's 200 and 400. There is a new $500 non-refundable credit. So if you don't owe tax, you won't get this back. But I actually had a client call today and he said, my 50-year-old son moved back in with me last year. And he said, can I claim him as a dependent? And we went through, what makes him a qualifying relative. And his son is a qualifying relative. And going forward, he will get this $500 non-refundable credit for that qualifying relative. I also have one other client who claims both of his parents who live with him. And he's supporting their parents. And so, any of you got college kids out there, 18, 19, 20 years old that are all supporting themselves now? No one? Bill, nice job, Bill. For most of them, you're still supporting them and you're still taking care of them. You weren't getting that child tax credit for them anymore because they were over 17. And now they will qualify at least for this $500 one, so not all hope is lost. I'm pretty sure that might cover like the food that they all eat when they come home on break and that kind of stuff. So. That's their plan. Like 40% of college kids, their plan after school is to move back home. So that $500 could help a few people, or help quite a few people who haven't been getting that credit before. So. With that, I'll turn it over to Michelle, and she'll wrap the night up for you. We'll open up for Q&A. She'll finish up your personal stuff and talk about our yearly credit.
Thanks, Jennifer. So how many people are still awake? Come on. We've only been here an hour and a half. We have a long time to go. I can keep you here another hour, right? Well, I'll try to make this short and sweet. I'm just going to finish up on some of the individual stuff. One of the changes is alimony. So alimony, if it's set in the divorce decree, in the past, the person receiving the alimony had to record it as income, and the person paying it had to record it as a deduction. Well, under the new act, starting after December 31st, 2018, so in 2019, any divorce decree or separation agreement that has been executed past that date, now that alimony is not included as income and is not able to be taken as a deduction. So that's one change. It does say that if you have a divorce that happened before December 31st, 2018, you could modify it to include this and follow this law then. But the question is who do you think, if there's a husband, I always use the husband, if the husband is paying alimony, do you really think you're going to get that husband to sign off on changing this agreement so he loses that deduction? Probably not going to happen, but you never know. So they just put it in there, but I don't think that will ever be used. Next is moving expenses. So in the past, if you had to move because of a job, say you took on a job, lived in Bismarck like I used to, and moved to Rapid City, I was able to take a moving expense because I moved more than 50 miles away from my old job. And if it was not reimbursable or reimbursed by the business or by your new employer, that now has been suspended for 2018 through 2025. You are not able to take that moving expense deduction. They do allow this for the military, the armed forces that are pursuant to a military order, but the only thing is that most of the time it's all paid for by the government and they don't have any expenses anyway out of pocket, so I don't know really why they would have put that in there, but they did. So, next, AMT. Who loves AMT? In the past, as you can see, the limits with this new act has increased. The 2017 was starting for single at 54,300. Well, now for 2018, it's bumped up to 70,300, and then for joint, 84,500 up to 109,400. The biggest thing though is actually the million or the phase outs, because that's where they finally really increased it. Because AMT was first created to make the rich pay. Because the rich, they said before, way back in the day, were always finding deductions to take. And so what they did, or Congress did, is they set up this AMT tax, and they expected only about 150 taxpayers to ever be subject to this. Well, the problem is when they set it up, they never set it up for inflation. So even though everybody's wages have increased and everything, and everybody's making more money, this limit did not. And so it started, or this tax did not. So then more and more of the middle income taxpayers were now being subject to the AMT tax, because when the AMT tax is calculated, you have to add back your personal exemptions, your 2% miscellaneous itemized deductions, your sales tax. So it could be where middle income family with a family of 5 could be subject to AMT tax, but just because of their personal exemptions. And so finally Congress has tried to fix this, and one is they fixed it because now we don't have personal exemptions. So now that's not one of the add backs. Plus then with this large phase outs, the $1 million and the 500,000, we expect really nobody to be subject to AMT tax anymore, or very few people. And then one other thing to think about is if in the past you've been subject to AMT tax, then you start getting a credit that you can use in future years. So if you have that credit carrying forward, we're expecting that it will now be able to be released and be used starting in 2018 and in the future, and start to reduce some of your tax. Next is 529 plans. So 529 plans in the past have been only being able to be used for colleges. You can pay for tuition or anything. Now, starting with this new law, is you can actually use it for private elementary and secondary schools. So like for Rapid City, we always say if you have kids going to St. Thomas More, Rapid City Christian, any of the private schools, you can actually pay the tuition out of your 529 plan. And the only thing to keep in mind though is you can only spend $10,000 per student per year, but for some of these schools around here, that'll cover it for each student. So they're just trying to expand the 529 plans in case, so then trying to get more people to be, set them up and be able to use them. Kiddie tax. So in the past, kiddie tax has been subject to with kids' tax returns that have unearned income. So unearned income is interest, dividends, and capital gains. And if the kids had unearned income of over $2,100, then they would be subject to this kiddie tax, and this kiddie tax was actually based off the parents' tax returns. And so in the past, we have not been able to compare the kids' tax returns until we finished the parents to figure out what tax rates they were at. So it's been kind of a hassle sometimes. But under the new law, they've actually now, the kiddie tax is not subject to the parents' returns. They are actually subject to the estate and trust tax rates. So one benefit is now we don't have to wait for the kids' tax or the parents' tax returns or even siblings' tax returns to be done. We can just base it right off the kids'. Of course, with kiddie tax, it goes where any kid up to the age of 17 is subject to this if they have unearned income over $2,100. And if you're 18 years old or 18 years old and do not have unearned income more than half of your support, you could be subject to this kiddie tax. Plus, if you're 18 years to 23 years and you're a full-time college student and don't have earned income up to half of your support, you could be subject to this. So we still have to follow those rules. So a lot of kids really are subject to it. And the Congress and the IRS have set this up mostly so the parents would not just shove all the investments into the kids' return or kids' names and try to get the lower tax rates. But the thing you can see, or the thing we'll look at the next screen is, it's beneficial, of course, that we're not having to deal with the parents' returns, but we're dealing with a lot, or new rates that are small, and that go up very high, actually. So when looking at this, the first $1,050 of unearned income for a kid is still taxed, or still tax-free. And then the next $1,050 is taxed just at 10%. But then after that, we have to use anything over $2,100 of unearned income, we have to be using these brackets. So you can see the first $2,500 above is taxed at 10%, then it jumps to 24, 35, and 37. So right away you can see that these brackets, if you look, the income is a lot smaller than the parents' tax brackets were. So that's one downfall with this new law, is that if your kid, or if the children have a lot of investment income or unearned income, they could be paying a lot more tax because of this new tax law compared to if they were going off the parents' tax rates. So, and then as you can see, that the top bracket is 37%, and that starts at income 20 or 12,500. So if you add the 2,100 of free or 10%, then you're looking at $14,600. If you have any over that, you're looking at the top tax bracket. Plus, you're also looking at the 3.8% net investment tax, because income over, with estates and trusts, income over the 12.5, you have that additional tax on that, compared to if you're a married finally joined, that tax, or that 3.8% doesn't come into play until a lot higher income. So those are a couple downfalls with this new kitty tax law. Next is the dead, I like to say. We'll end it on this then, kind of. Federal estate tax, of course, is tax on property transferred from deceased persons over to the heirs other than their surviving spouse. And estates with assets above the current estate tax exemption is subject to this 40% tax rate. So the question is what is the current estate tax exemption? So in the past, in 2017, you can tell for individuals it was 5.4 million, and for joint 10.98. Well, for 2018 to 2025, that has doubled. So now an individual can pass away with $11.2 million of assets and not have to pay any estate tax, which everybody thinks, that's great. But look at the date though, because starting in 2026, we go back down to the 5.4 and the 10.98. So the question is that how can we plan, or what can we do to try to use this exemption during this short time period? And so before we get into some planning options, let's give an example. So if an individual had an estate of $12 million, if they die in 2025, they have a taxable estate of $800,000, which is 11.2 minus, or the 12 minus the 11.2, and they would have $320,000 worth of tax. But if they wait and die 1/1 of 2026, their taxable estate bumps up to $6.5 million, and they have $2.6 million of tax. So who really wants to have to pay, or use up their estate to pay for that $2.6 million? So looking at that, some options is during 2018 to 2026, you are able to gift away. So you, with the same as the state tax exemption is a gift tax exemption. So during this time, you would have the option from 2018 to 2025 to actually gift away your up to $11.2 million. The other option would be if you knew what the future held and you knew you were going to pass away before 2026. And if you knew that, then watch out, because you might have a lot of other people coming to you to think that just figure out if they will too. Because if they knew that they were going to pass away before 2026, then there's no tax planning really you need to do, because you have a $11 million state exemption. But one thing to keep in mind when we go back to the gifts is that if you gift away, the beneficiary that receives that gift is getting your cost basis. So if you ended up buying land a long time ago for $100 an acre, and now it's $1,000 an acre, if you would gift that land away to, say, a son, that son now has only $100 cost in that land instead of $1,000. So they lose that step up on basis, because if a person passes away, or when a person passes away, every asset that that person owned jointly or by themselves, they get a new basis in that asset, and it's the fair market value at the date of death. So this is huge for, say, farmers, because going back to that land value, if they would have gifted away, like I said, the beneficiary only has a $100 basis in it. But if the person passes away, and through the estate it passes over to the son. Now that son has $1,000 cost basis in it instead of the 100, and if he would end up selling it, he would have no gain that he would have to pay. So no tax he'd have to pay on it. Where if it was gifted to him, he would have a $900 per acre gain that he would have to be paying. So you can see it's a big tax advantage just to, if you're able to hold on to assets and pass them through when you pass away, so then they get this step up in basis. And in addition, assets that are used in the business, say if I go back to a farm or ranch, assets like cattle or equipment, combines or anything, they would actually get to start being depreciated over again. So if you had raised cows and you had no depreciation on them before, when that person passes away, you get a new cost basis in it, you get to start depreciating them all over. And so it's additional deduction that the ranch would be able to take, which would bring down that taxable income. So there's a lot of times actually, because in addition to that, when you think about it, if any of the hay or any of the grain that might be on hand at the date of death gets a cost basis, so when that's used, you get a deduction for that. And so it brings down a lot of ranches after somebody passes away. A lot of ranches have losses because of all the additional depreciation and deductions that they're able to take. And after that, the only thing that we wanted to kind of talk about is, we've talked a lot about changes that have happened, but with this new bill, but some of the key tax extenders that have not passed, that actually expired December 31st, 2016, that we haven't heard about, and we assume that they're going to be just dead, but we're not too sure, is Section 179D. We saw that a lot in construction. We saw a lot with the Indian Employment Credit, right now is expired. The Empowerment Zone Credit, and then another one that we used to see a lot is premiums on mortgage interest deductible as interest expense, as itemized. So there's still talk that they might, in this next month, might still extend these and make them retroactive, but for 2017, but we just have to kind of wait and see. So with that, we're opening it to questions. Any questions for any of us? Somebody's got to think of something. What was that?
Does the state of South Dakota in ranches and farms allow for a transfer on death deed? So the son could receive the land just by quote, could be equivalent to like the 11 o'clock hour of dad's death. And that becomes his asset because it didn't go into the estate. I think in Wyoming, he gets a father's basis, original basis. Does South Dakota have that?
I don't think so.
Yes.
Correct? Oh, it does? Yeah. It does? Okay. Yeah. Yeah, that's the legal part, but yeah. So it does, yeah. But of course, we would rather have the step up basis. We would rather have it in hands.
Unless you're up to 2026, then you're trying to get that asset into somebody's hand, but it goes to the higher tax.
Yeah, but then there's other options you can look at. So just to try to reduce your estate under, but still be able to keep like a lot of assets, because that's where you might want to gift assets that have a higher basis to away, but they keep the lower basis assets that might have a large step up in basis. So yeah, there's planning with that.
So is the cost